Since the investigation and the scrutiny from both the US and the Chinese government, many Chinese stocks listed in the US have seen their stock prices fall very sharply, especially in July and August. The pressure is real and the tech companies are really feeling the pain. Is it now an opportunity or a trap? Let's take a look at the two charts from stockcharts.com. We have Tencent, JD, Baidu, Meituan, Alibaba, PDD, and Tencent Music. As you can see that all of Chinese stocks, they have been trading down. Tencent, Alibaba, and JD are down 40%. Baidu and Meituan are down 54%. PDD is down 60%, and the Tencent Music is down more than 70%. These are insane losses. In addition, I also have a chart of my 3 favorite Chinese tech ETFs. CHIQ China Consumer Discretionary ETF, ECNS iShares China Small Cap ETF, and KGRN Crane Shares China Clean Tech Index ETF. CHIQ is down 35%, ECNS is down 23%, and KGRN is down 19%. These are some of the best performing Chinese ETFs, and their numbers are not pretty either. One interesting fact is that this Chinese sell-off is even bigger than the COVID crash sell-off. So everything has been trading down for almost 7 months. Is now an opportunity or it's a trap? I have a few strategies of my own that I think it will lower the risks, but at the same time, I still have access to these Chinese stocks. But before we do that, allow me to give you a very quick overview of some of the major Chinese stock-related events that happened this year. At the end of 2020, Jack Ma's record-breaking $37 billion Ant Group's IPO was suspended, and it had estimated valuation of $300 billion. Soon after, Alibaba was targeted with anti-monopoly investigation because of their choose one from two policy, and Alibaba later was issued a $2.8 billion USD fine. In April, Tencent was punished for failing to meet regulatory requirements when they acquired some mobile digital service and social network companies. Didi and Suning were also fined by the SAMR over anti-monopoly breaches in the same month. Meituan took over a digital membership management service provider, and it was flagged by the SAMR over anti-monopolistic practices and labor issues. On July 7th, there have been a total of 22 cases involving Tencent, Alibaba, and Suning, according to an official statement from the SAMR. In the same month, Didi's disastrous IPO in the US, apps banned from the app stores in China and sending share price sharply lower, and it was investigated over cybersecurity and national security risks. These are the major events that happened from the end of 2020 to August 2021. After my research, I have found 3 major concerns that investors have. Number 1, Chinese companies are too risky due to VIE structure and the regulations. Number 2, accounting and fraud concerns. Number 3, Chinese companies' growth rate will be much slower due to the crackdown. These are all valid concerns, and I would like to address each one of them and let you know what I think. Concern number 1. Chinese companies are too risky right now due to the crackdown, and the risks come with the VIE structure is just not worth it. Most investors, and me included, we think that these companies have good fundamentals, but the Chinese government and regulators can take it away anytime they want because of the VIE structure. And in addition, there is the possibility of being delisted. China's regulators continue to put pressure on the tech sector. US filings show that a lot of funds and firms have been dumping shares. For example, Cathie Wood's ARK ETF is now sitting with no exposure to Chinese stocks. Other high-profile investors have taken similar steps, including George Soros and Paul Marshall. It is clear that people are afraid of Chinese stocks now more than ever. The VIE structure and the possibility of being delisted do not add comfort in the current situation. Furthermore, Chinese ride-hailing company Didi's disastrous IPO definitely instilled fear in investors. These worries are definitely valid. However, VIE has been working for more than a decade, and the Chinese government hasn't done anything destructive so far. According to a report by CNBC, quote, China's securities regulators will continue to allow Chinese companies to go public in the US as long as they meet listing requirements, end quote. And Didi's IPO was not an arbitrary crackdown. According to Wall Street Journal, quote, weeks before Didi Global Inc. went public in the US, China's cybersecurity watchdog suggested the Chinese ride-hailing giant delay its initial public offering and urged it to conduct a thorough self-examination of its network security, end quote. So it's clear that the Chinese regulators suggested Didi delay its US IPO, but for Didi, they didn't wait. They went ahead and thus the crackdown. So everything happened to Didi was their own misjudgment. China definitely commands huge authority and the country over a company for sure. But I do not believe that the Chinese government wants to scare investors and destroy their own companies. According to the Shanghai Securities News, which is owned by the official Xinhua news agency in China, it ran an article saying there is no systemic risk and that stock valuations are expected to rebound. According to South China Morning Post, China's state media moves to reassure rattled investors after rout wiped 574 billion of stock market. Delisting is also a huge concern. But Holding Foreign Companies Accountable Act HFCAA will only affect companies which are not able to comply with the regulations. And the main targets are state-owned companies and their subsidiaries in electronics, aerospace, construction, and shipbuilding. I wouldn't worry about this because as a matter of fact, if Chinese companies are more prone to get audited and these high accounting standards should ease concerns over accounting fraud, which leads to the second major concern that investors have. Number 2, accounting and fraud concerns. According to the press release by SEC, Luckin Coffee was charged with, quote, defrauding investors by materially misstating the company's revenue, expenses, and net operating loss in an effort to falsely appear to achieve rapid growth and increased profitability and to meet the company's earnings estimates, end quote. This high-profile case definitely made a huge impact on investors' confidence for all these Chinese companies. However, it was one bad example out of more than 200 companies that are currently listed on the New York Stock Exchange and Nasdaq. There are other Chinese companies were hit by allegations of fraud. Muddy Waters, a company that conducts investigative research on public companies, accused Chinese social media firm Joy, US ticker YY, of being fraudulent in user metrics, revenue, and cash balances in their 71-page report. Muddy Water at the time held short positions against Joy, but investment firms came out in support of Joy and sent Joy's stock 17% higher. Furthermore, Muddy Waters and Wolfpack Research accused IGE of inflating its revenues by 27% to 44%. However, both companies mentioned above have not been officially been charged with fraud. And the biggest recent time stock scams such as Bernard Madoff in 2008, HealthSouth in 2003, Tyco International and WorldCom in 2002, and Enron in 2001. All of these are not Chinese companies. Having said all of this, the risks still exist, and we just need to find ways to minimize our risks and maximize our profits. Concern number 3. The growth rate of Chinese companies will be much slower because of the increasing scrutiny over anti-monopolistic practices. China's antitrust regulator ordered the music streaming giant Tencent Music to give up exclusive rights to music labels, Shares in Tencent and Tencent Music have fallen after China ordered they must end exclusive music licensing deals with record labels around the world. The State Administration of Market Regulation said Tencent's acquisition of China Music Corporation in 2016 has more than 80% of all music rights in the market, and it has unfair advantage over its rivals. These activities broke the country's anti-monopoly rules. Tencent then said they can no longer engage in exclusive deals over music rights and must dissolve any existing agreements within 30 days. However, they still can retain exclusive deals with independent artists because these contracts expire after 3 years. Tencent paid a fine of 77,000 USD, which is nothing to Tencent, and said they would abide by the ruling and comply with the requirements laid out by the regulator. So antitrust regulations prevent growth rate, but at the same time it gives opportunities to the smaller players, and that make room for newer and more innovations. Chinese regulators also blocked Tencent's plan to merge with video game streaming sites Douyu and Huya, where Tencent owns more than a third of Douyu, but the regulator allowed Tencent's acquisition of Sogou, China's second largest search engine. So it's clear that these regulations are not there to hinder companies' expansions. It is to stop unlawful and unfair monopolistic behavior. As long as they follow the regulators' guidelines, mergers and acquisitions can still occur. In conclusion, I definitely agree that there are risks investing in Chinese companies. However, there are a lot of changes indicate and show that China wouldn't want to destroy its offshore companies on purpose. And I believe China wants to be an investment hub for the world. They want more foreign capital to come into the country and boost international use of its currency. Some of the most recent developments in the industry are in the Chinese futures market. According to Reuters, JP Morgan gets China's approval for the first fully foreign-owned futures business. In addition, China's central bank also gave the final approval to a network clearing license for an American Express joint venture, allowing it to be the first foreign credit card company to launch onshore operations in China. These are bold and solid moves by China. However, we never know where the dip is, and the sell-off could continue. Finally, I have 3 strategies here I think that could limit our risk and still have access to these Chinese stocks. The first one is to limit your exposure and buy companies that have been audited and trustworthy. Companies like Baidu and Tencent are very well recognized. The second one is to diversify your portfolio. Don't concentrate on one particular stock. Buy ETFs such as CHIQ, ECNS, and KGRN. By doing so, you have the access to a lot of different Chinese companies, and it's very unlikely that all of these companies would be delisted or found guilty of fraudulent activities. And all of the Chinese ETFs have taken a hit in the past 7 months. It just might be your opportunity right now. And I think solar and battery technology ETFs are looking great. And finally, I think the safest action you can take is to buy stocks of the companies that you really like on Hong Kong exchanges and clearing. If these Chinese companies are delisted from American exchanges, your ADRs can be converted. Alright, do you think Chinese stocks are dangerous? Let me know in the comment section down below, and like and subscribe. This is Grant. Trade and invest responsibly.